I just find it incredible, like, if anyone had told us at the beginning of the year that there would be this divergence between what the Fed would do and the ECB and even the Bank of England, I don't think anyone would have believed them.
No, I think that's fair, and the main delta in that is US exceptionalism around growth, and therefore, central bank policy, and obviously that's feeding into FX and into rate markets and equities as a result of that. So no, I think that's been quite stark. But my sense is, as I say, globally, you are starting to see growth starting to lift across the board. Now, I don't think Europe's going to get anywhere close to US growth rates. The US is benefiting from a surge in immigration, increased labour force participation rate. All of that is boosting consumption. And I think those dynamics are not in play in the Eurozone to the same extent. But I do still think growth will lift in Europe as we go through this year.
I mean, is there a discount because of political uncertainty in Europe? I know there's the European parliamentary elections. Don't get me wrong, there's a big election in the US as well, which could change the trajectory. But is it discounted in the market right now?
So the European market is trading at a 30% discount to the US. It's been that way for quite a while, so I never see valuation alone as a reason to buy into an equity market. You need a catalyst. And I think when we look to Europe, which is a market that we are favourable about, particularly the larger cap multinational companies, the two catalysts that I'd point to is firstly this modest recovery and growth, and the fact that the ECB, we think, are going to cut rates before the summer, and that should be a catalyst for risk. The second thing is when we look at European balance sheets, they are totally transformed. We're actually in a situation now where, rather than European companies being a net issuer of stock, rights issues and the like, that many still carry a lot of baggage when thinking about Europe, particularly European banks, around net issuance. Actually, Europe is buying back stock at a rate faster than it has in a very long time. And so when you look at the dividend and the share buyback yield, that total return story is stronger for Europe than it is for the US. So a couple of catalysts there that I think will prove interesting this year.
But if you look at the ECB, do they have to work that much harder if they're going against what the US does? So we're expecting something in June. I mean, the market repriced to about 75 basis points in total. I mean, maybe do they need to work harder?
I think that they'll be more mindful of making sure, obviously all the central banks are looking for evidence that we're on a sustained path back to their targets when it comes to inflation. And we saw very strong disinflation in the US through the fourth quarter that's obviously now starting to stabilise a little bit with these three inflation prints that have surprised to the upside. So I'm sure the ECB and the Bank of England will be watching that, and it just brings in that extra note of caution, which I think is what the market's pricing today. And then obviously rate differentials as well as growth differentials are a key driver of currencies, and so that will be another thing.
I was going to ask you how you play the currencies actually in this kind of environment. We've seen some huge, and then I'll ask you about yen and also some of the renminbi in a while. But if you look at euro-dollar, does it make a difference in what kind of companies you want to be invested in?
Yes, I think, just in terms of the FX impact, certainly dollar strength with US exceptionalism feels more likely. I think in theory, Europe, when we look at particularly those large companies in Europe, many of them are exporters. And so, euro weakness in theory should help. But these things are always actually really hard to map because of hedges and everything that companies have in place. But I think that recovery in European growth dynamic equally could support the euro. So I think actually when we're thinking about FX, it's probably one of the hardest asset classes at the moment to balance. But whether it be in fixed income or in equities, I think there's a good story to be had for Europe.